down 15% in 2022. Is Starbucks stock an excellent dividend stock to buy for 2023? I'm going to answer that question in this video, so stay tuned. So to answer that, let's look at a few different metrics for Starbucks, starting with its quarterly revenue growth going back before 2014. And you can see just a very nice upward trend. Of course, during the pandemic, its sales were devastated because it needed to shut many of its stores, especially those that didn't have drive-through locations, and so sales collapsed from more than 6 billion to less than 4.5 billion. But like you can see, it was a quick V-shaped recovery, and now it's got in its most recent quarter sales of 8.4 billion, are well above its previous peak. So the company has recovered stronger than ever, and now it even has this enhanced digital business that it didn't have as strongly as it does before the pandemic. Now you can order on the Starbucks app and pick it up in store or have it delivered to your house, and that program has been really boosted during the earlier stages of the pandemic, when Starbucks management noted, hey, if we want to keep making sales during these lockdowns, we've really got to enhance our app. We've really got to partner with some third-party delivery providers to make sure we can get to people's homes. And so now it has that part of the business that it built during the worst stages of the pandemic to supplement its already popular in store business. And you, if you're a Starbucks fan, I'm sure you know, anytime you go inside a Starbucks, at least in the ones near my home, there's in fact surprisingly, there's 4 Starbucks near walking distance of my house. Walking distance, 4 Starbucks. And any waking hours that I've visited those Starbucks, they've had lines going back several feet, and the drive-throughs have been backed up all day long. So it's just an incredibly popular business with its customers. It keeps attracting new customers, keeps existing customers coming back. As you can see, evidence of that in its excellent revenue growth over the last 10 years or so. The next thing I want to look at is its operating income. I want to see how that revenue is translating into operating profits. And I want to look at 2 different stages. I want to look at the stage before the outbreak, so before 2014 until right before the outbreak caused the crash. It was a very nice upward trend in operating income. So as revenue was growing, its operating profitability was growing, and you saw very healthy operating profit margins between 15 and 20% for this company. And then, of course, it crashed during the outbreak, and it took the time to restructure some of its business. It closed down some downtown locations and opened some more suburban locations as it started to notice remote working is going to be more permanent. And so that was a non-cash expense, and some of it was cash. So it changed a lot of stuff during the earlier stages of the pandemic, leading to these losses. And now it's just about stronger than the operating income is above where it was before the pandemic. And that's only going to get stronger as now China's economy is reopening now. That's been the last economy to really reopen, and Starbucks has a strong presence in China. It's its second largest geography behind the U.S. and Canada. And as that economy reopens, sales for Starbucks and profitability is set to rise over there. Starbucks, if you don't already know, its store level operating margin is higher for its international stores compared to the domestic locations. So as international stores gain more proportionally in terms of the revenue mix of the business, that's going to lift its operating profitability for the business, right? $100 in revenue in international segments is more valuable to Starbucks than $100 in revenue in its domestic business in terms of profitability. And so that's going to be a lift to Starbucks in the current year. All right, and then let's look at its dividend growth. If we go back before 2014, this is dividends per share quarterly. Starbucks was giving a dividend per share less than 15 cents. Let's round it to 10 cents per share. And that has risen all the way up to 49 cents per share in its most recent quarter. So dividend investors from 2014 are now getting 4 or 5 times the dividend per share they were getting back then. And so if you're a dividend investor today, if you're a passive income investor today, you can reasonably expect Starbucks to continue raising its dividend per share for the next 5 and 10 years. The company is still in growth mode. It's still opening new locations and it's still increasing comparable store sales in each location. So it's still very much a growth company and you can continue to expect increases in dividends per share for the next 5 to 10 years. All right, finally, let's look at valuation. And I'm going to look at Starbucks' price to earnings ratio forward. And it's selling at a PE of 31, which is about the average it has sold for going back for this last year. It was a bit higher before 2022 in 2021. During 2022, you could have had it at a lower valuation at about 24. And right now at 31, it's about the average you've been able to buy it. But the good news is that one of the major risks has been reduced for Starbucks stock, right? And I often say this in the comments in my channel. Some investors sometimes ask me why I would prefer to buy a stock at a higher price if a risk is eliminated. And Starbucks is a primary example of this, right? I would rather buy Starbucks today at a price to earnings of 31 than at a price to earnings of 24 just after September of 2022. Why would I do that, you might ask? Because there's been more clarity in the reopening of the Chinese economy where Starbucks has a large presence in. Nearly 10% of its sales come from China, and it's the second largest geographic market. And that's where Starbucks intends to add the most stores, right? The most store location growth. So now that China has announced it intends to reopen its economies, starting, it's already kind of had a rolling start. It's kind of reducing restrictions. That's a risk that's been reduced for Starbucks. It can now grow its stores more easily than before because there's fewer restrictions in terms of movement and people movement. And also, more people are going to be moving around in China, more customer mobility, and so sales are going to grow, profitability is going to grow. So a major risk has been removed. So I'd rather buy it at 31 with that major risk removed rather than 24 with that risk still around, with me wondering when is China going to reopen its economy, not knowing when that's going to happen, how long that's going to hurt sales and profits. Now that I know, I'd rather pay 31. So that being said, yes, I would recommend Starbucks stock as a buy, an excellent dividend stock to buy for 2023. All right, so thank you for watching. I'll see you next time. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.